Welcome to Breaking Banks.
Well, welcome back. I'm your host, Brett King. Joining us today in the hot seat is Scott Sanborn. He's the CEO of Lending Club. He was one of our very first guests on the podcast, actually, going back to 2013. We're coming up on our 8th anniversary, Scott, so that's pretty epic, right?
Yeah, the world has changed just only ever so slightly in those 8 years.
Yeah. So Scott looks after, of course, I'm sure you're all familiar with Lending Club. It's the only full spectrum fintech marketplace bank at scale. They were one of the first to really show strong support in terms of crowdfunding and so forth from big pension funds and so forth. They've helped more than 3 million Americans save billions of dollars since they were founded in 2007. That was in the early days of fintech, before we even called fintech. Scott leads the company's vision of creating unprecedented value to borrowers and investors through Lending Club's online credit marketplace and constant innovation. And recently, Scott was named Executive of the Year by Lendit for his leadership and positioning the company for its next phase of growth. And we've been doing this podcast for so long. When Scott first joined us, he wasn't the CEO, he was the CMO. So he's gone up in the world since then. Scott, welcome officially to the show, back to the show.
Yeah, well, great to be here again, Brett, and good to reconnect.
When you started, you were a startup, and obviously, you guys have been through the IPO and so forth. But from being one of the founding team and being with, Lending Club for so long, has it changed the culture of the organization, or do you feel like it's just there's obviously more admin work and being a publicly listed company, but culturally, how's the organization adapted?
Yeah, of course. It isn't, despite what anyone may tell you, I don't think it's really possible to, when I joined the company, it was 35 people roughly. And we're well over 1,000 today. You can't have the same culture as a private 30-person company, as a public and now directly supervised entity. But what you can keep and what we have kept is our values. And this dates way back to 2012. When we were at that stage of hyper growth, and people that I didn't know were hiring people I didn't know, that were hiring people I didn't know, and I was concerned about how do we preserve the culture. And I was talking to some advisors and colleagues and friends and saying, what do you do? And the answer that I got, which really resonated, was document what your values are and stick to those. The culture will evolve around it, but if you keep your values straight, the company will feel the same. And so we did that. We put on a piece of paper our core values. We've updated them only twice since then. And if you saw the values from 2012 and the values from 2020, you would say, oh, I recognize it. It's the same company. So even as the operations have changed, the way things get done have morphed, what makes a lending clubber is really stayed consistent all the way through.
So you guys call yourselves clubbers?
That's right.
That's funny.
Yeah.
Yes. That's whole lot of connotations from that. But now you've of course upped the ante on the complexity by buying Radius Bank. First of all, this is a bit of a trend right now. We're seeing, we just saw Grab do a SPAC, a very successful SPAC in Singapore. Gojek acquired a bank in their market. Of course, we know Google's had a bank for a long time. Talk me through that process in terms of the realization when you decided on this, and what was the real driver behind this?
Yeah, I mean, it's not a decision you undertake lightly. It's a big commitment, but I would say it is not hyperbole to call it really transformative, just on multiple levels, both financially for the company, but as importantly, strategically in terms of what we can do for the customers. And we're clearly seeing the trend, and the reason we're seeing is it once you achieve a certain scale, it just makes so much sense. So like the on the financial side, we are, really changing the business. We're eliminating a ton of costs. We, as one of the largest unsecured lender in the country, we were paying issuing banks to issue loans on our behalf. On average, that was $20 million over the last couple of years per year. So that cost goes away. We can issue our own loans. We had warehouse lines, pre-COVID, about $1 billion worth that we were paying, call it 330 basis points on. We're now swapping those out for deposits at 35 basis points, so a 90% reduction in funding costs. So that's on the kind of cost elimination side. And then on the revenue addition side, we now get a new revenue stream, which is interest income. Instead of selling 100% of our loans, which is what our model was, we'll keep an average of roughly 20%, and we'll earn the interest income against that. So it's a whole new revenue stream that is a more kind of resilient and stable stream. So that's just the financial side, and it's extremely compelling. And then of course you get the strategic side, which is we can just do way more for our customers. We've got more than 3 million customers we call members. They want to do more with us. We've been helping them. We've made access to credit really frictionless. And they, but that's all we've been doing is helping them with lending. And now we're going to be able to help them with spending and saving. So there's just a ton there. It's no surprise others are looking to do it. We're glad we have it done, because wanting to do it and getting it done, as I'm sure you've seen, are two very, very different things. And it's taken many players, 3-4 years to get it across the line. And we were able to get this transaction closed in 12 months.
Because the obvious question was, you partially answered it already. Your business is a marketplace, and so you don't want to take too much of the lending off the top. But, how much are you lending annually these years? Because I would imagine you're probably lending more than most banks in the US.
Well, our unsecured lending was pre-COVID. We did about 12 billion annually. We pulled way back in COVID, just due to the nature of the marketplace. But we've put out guidance this year for about 45% growth in lending, 55 in revenue. But what we're looking to do is really get the benefits of both sides. Like versus banks, to your point, we can grow more rapidly. We're not limited by our own capital because we have other people providing capital. And our growth is going to be fueled by both the interest income on loans we keep, as well as the fee income from loans we sell, which will generate more capital and allow us to grow. And we're more efficient than banks at customer acquisition because we've got a national footprint and a broad spectrum of approval, because we're not just approving bank quality loans, we're approving a full range of consumers. And the loans that are not bank quality wouldn't go on a bank balance sheet typically. We're selling to asset managers, hedge funds, and others. And obviously versus banks, we don't have that legacy infrastructure with branches and the old cores. But versus the fintechs, we're bringing a much more resilient model, right? Access to stable, low-cost funding with a recurring, sustained revenue stream, which is just going to make us more profitable. So
now, banks, of course, do the whole wholesale piece where they use lending providers, but you've got that advantage in that you've got a much bigger crowd behind you in terms of support for that. And so, very interesting ways to de-risk and spread risk and all of those sort of things that, a wholesale lending provider may not necessarily have. And as far as I'm aware, it's only you and Zopa who have sort of now got models that offer traditional bank lending like that, right?
Yeah, I mean,
maybe Grameen, but
the other advantage I'd say is our superpower is that we're market leader in amongst the most profitable segments of lending, right? Unsecured consumer is highly, highly profitable. So that's the financial side of it. The strategic side is it also happens, our core value proposition is, hey, Americans, for the half of you who didn't pay off your credit card last month, you have a loan. It's a crappy one. Let us save you money. It's going to take less than 2 minutes and put money in your pocket.
Yeah,
So
halve your interest rate.
So we're basically
Or better.
creating this. We're basically creating at this massive scale a huge affinity and connection to customers while generating a really profitable asset. So coming at a lot of the people coming at innovation and banking have been coming at this from the deposit side. We're coming at it from the lending side. And as you know, that's where the money is primarily made in banking. So we're bringing this real scale in a very profitable part of the business and a sizable customer base to innovate from that side. And now we're adding, with the acquisition of Radius, we're actually not just acquiring a charter, we're acquiring real capabilities. They've got a really powerful, award-winning checking account that is, again, it's directly on strategy. The checking account that the rewards checking we're acquiring, the basic product is we're going to reward you for spending money you have by using your debit card, not reward you for going into debt.
This is
directly
absolutely something I support. I'm on the board of the Financial Health Network, but this whole thing about spend more money and get cash back or get airline miles, it's almost as if after the pandemic, that can't really be a core strategy. The job of a bank or an institution like yourselves should be first and foremost to help customers manage their money better, right?
Yeah, one of the things we talk a lot about is by setting up the incentives of the company to be aligned with the outcome of the customer. There are so many places in banking where that just isn't the case, right? And banks become addicted to the income generated from things that are actually not reflecting positive customer outcomes. And so going into it clear-eyed with what you're trying to do for your customer, and what we're trying to do is take it one step at a time, lower their cost of debt, which will create an opportunity for them to have savings. So now we can help them actually accomplish savings. And then over time, it'll be to grow that into setting aside money for the future. But the simple thing we want to be able to do now is you come in because, we refinanced your car loan, we saved you $80. Imagine a world where we say, hey, we can either have you keep driving the same car, pay off the loan in the same time period, and save $80 a month. We can lower your payment by that much. Or what if we said, look, how about we lower your payment by $40 and the other $40 we put into a savings account.
Awesome.
By the time you're finished paying off your loan, you've got $5 or $6 grand set aside, to act as a buffer against future shocks. And again, what's aligned here is because you have that in a savings account with LendingClub, we can lend against that and we can earn money off of that, and not have to earn money off of, having you need another personal loan.
So let's talk about the sort of portfolio of loans that you've got. I remember, we talked back, a few years ago, you talked about debt consolidation being one of the primary use cases scenario. But, we see a lot of new activity in the space, buy now, pay later, that sort of stuff. So, you're trying to look for a different mix of loan types, and how do you see the buy now, pay later sort of shifting, people's use of lending away from credit cards and onto sort of, different modalities?
Yeah. So our, core use case, brand value proposition, what we're still bringing in most customers for is refinancing their existing debt at a lower cost and saving them money. Like I said, that creates kind of a customer for life. We have really high NPS scores, and then our goal is to do more for them over time. That said, half of our customers come back to us within 5 years to do business with us again, based on their positive experience with the first loan. And there we see the use case start to shift. Case one might have been credit card consolidation. Case two might be, I'm adding a deck onto the back of the house, or I want to buy a hot tub. So we do see that, and are agnostic. Our goal is to make it easy for people to make smart choices with their money. And purchase finance can be a smart choice where, in cases where we have, for example, a decent sized medical business where for purposes that aren't covered by insurance, think about fertility treatments, bariatric surgery, these big ticket items that aren't covered by insurance, we have a role. When it comes to the broader growth of buy now, pay later, I would say we look at it, it is an alternative to credit cards, and especially younger consumers are showing their reluctance to get trapped in that minimum payment cycle. But we view it as an opportunity, both an opportunity for us to extend where appropriate to our existing customers, and still as an opportunity for refinance. Because if you look at those on average where they're charging an interest rate, which is a decent percentage of the overall volume in that space, you're looking at rates in the mid-20s, right? And when you go to someone and say, hey, this treadmill isn't $2,000, this treadmill is $50 a month, you're kind of a little bit masking the true cost to the consumer. And it's an opportunity for us as those things build up to say to them, hey, are you paying attention to what's happening over here? You're not paying a price that's reflective of your credit. You're paying a price that's reflective of the convenience of enabling your purchase.
Yeah, there's some early evidence that people in Europe were not aware they had to pay back the loans that they took with the buy now, pay later stuff. So a little bit of where the lower friction may be a little too low when it comes to financial health considerations. But it certainly wouldn't hurt the valuation, right? To have a sort of buy now, pay later platform.
Well, certainly there's a lot of growth in the space. It was very much accelerated due to COVID. And as I mentioned, we are actually active in the space, and we're active before the term itself was as cool as it is today.
Exactly. And let's talk about that. For you, you've been in this since the very beginning of the fintech revolution. Now fintechs are household names, not only in the US but globally. So, first of all, do you still think of yourself as a fintech, or do you think of yourself as a listed company or a bank? And do you think that the term fintech means different things now versus what it did in the past, or how would you articulate what fintech is to someone who doesn't know, for example?
Yeah, I mean, as I'm sure you would agree, things are getting really, really murky out there and gray. I mean, to the question, what are we? Are we a fintech or a bank? My answer is yes. We're obviously both of those.
That's
we're a bank because we're issuing our own loans and we take deposits. And we're a fintech because we're branchless, we're digitally native. We've got a culture of innovation.
You remain tech first, regardless of what you call yourselves, right?
Exactly. And I think the space is continuing to evolve I think it's exciting to see, because retail banking is one of the last frontiers to be really disrupted by technology to the benefit of the consumer. And it's really happening now, right? You're seeing consumer expectations for what is possible being quickly reset for the better, and you're seeing consumers respond. Right, they're voting with their wallets.
Absolutely, we've certainly seen that during COVID. So let's talk about product wise. You've spoken a little bit about your position you've taken throughout the pandemic, but has it changed any of the product direction, you think? More of a focus on, because people are going to be long-term having, financial difficulties or, economic challenges as a result of the pandemic. Even after we've all been vaccinated and COVID's tamed, there's still going to be the economic issues to deal with. So did that change your trajectory at all, you think?
I mean, our core consumer came into this pretty well prepared in terms of the household balance sheet, and they've actually weathered it quite well. It's one of the in the column of never waste a good crisis. One of the big questions that had always hung over LendingClub's head was, oh, great, you're category leader in the fastest growing category of credit, but you've never been through a recession. We have no idea how these loans, and for context, when I joined the company, the annual originations for personal loans was 10 billion, and pre-COVID, that number was like 140 billion, and we alone were 12. So there's this question, how are these loans going to hold up? And what we saw was really, really well. And in fact, both our internal data and third-party data from TransUnion showed, there's lots of debate to be had about the impact of stimulus and how much did that do to support credit, because credit more broadly held up pretty well. So what I'm referring to is, what is our place in the payment hierarchy? A lot of people said it's going to be at the bottom. You already gave them the money, that why would they bother paying you back? You're going to be down there with student loans. And that was actually not the case at all. In fact, our consumers prioritized us even above their credit cards and repaying of the loan. So I'd call that a really big check. It's a validation of how much they value the relationship with LendingClub. And in terms of what's next for us, given that, our big focus is going to be taking the capabilities we now have acquired with Radius and integrating those with our offering in ways I just mentioned. I mean, imagine a world where, hey, I'm going to save you, you're paying 17, 18% on your credit card. How about I give you 12% on a personal loan instead? And you know what? If you deposit into a LendingClub checking account, here's what else you get, right? A lower rate,
right,
double rewards, whatever. Like an integrated offering that then also gives us
the lower rate thing is going to be interesting.
Yeah, it gives us more insight, as we were talking in kind of the closed session up front, more insight into your spending, your income, and help us help you stay on track with what you're trying to accomplish, which is get out of debt.
Now, just a couple of weeks ago, you had your earnings report. Anything you can sort of cover quickly on that before we wrap up?
Yeah. I mean, for us, the big thing is we were in a corporate equivalent of shelter in place last year. We basically pulled back on originations, partly due to COVID, but also we really wanted to be positioned to have our capital unencumbered so that when a bank approval could come through, we would be positioned to acquire and capitalize the bank. Now that that's happened as of February 1st, we are very excited to be back, back in growth mode and back competing, and look forward to delivering a lot of value for shareholders and for our customers.
So just we've got a minute left to wrap up. So first of all, where can people find out more about LendingClub, and what should we be looking out for the rest of the year?
So where they can find out more is obviously on our website, or feel free to reach out to our head of IR or our investor relations at LendingClub.com. And what you can expect from us right now is company getting back into growth mode. What you're going to see is us generating significant loan volume and taking an increasing share of that on our balance sheet, which will drive our earnings. And you'll see us start to introduce new banking services for our customers that help us do more for them, while also have the nice benefit of driving our business.
Fantastic. Well, you've stuck with us through the last 8 years as well, and you've been on the show multiple times. I'm delighted to see that things are going so well, and that you got through your recession with flying colors. And all the best to you, Scott. Thanks for being back on the show.
All right, great catching up again, Brett, and I look forward to seeing the new book.
Very much. Great. All right, guys, we'll be back with you shortly.
How did Atlanta become this payments processing powerhouse?
Yeah, so thanks again. Yes, transactionality is the term that has been used by Fintech Atlanta, the Technology Association Georgia, the groups behind spearheading a lot of the economic development around the fintech world, culminating with our Fintech South conference here. And one of the reasons why that is such a important moniker for this city and really for the state really is a long legacy that has to do, to a large extent, with Atlanta having been this original transportation hub. One of the original names of Atlanta was Terminus. It was where the rail lines terminated here in Atlanta. And the evolution of telecommunications and data communications around the world and around the country, to a large extent, exploited the right-of-way on the rail line. So Atlanta really became a hub from a telecommunications perspective. Bell South, AT&T long lines, a lot of the mobile, wireless, and digital carriers. So a heavy concentration of telecommunications, data communications, transportation capabilities up through the 60s and 70s. And at the same time, we ended up as a pretty strong banking community with some pretty large correspondent banking operations. And in the early days of correspondent banking, CNS, Trust Company, First Atlanta, you basically are building big mainframe systems and sharing a lot of that technology and capabilities with smaller banks around the country that you're processing on the behalf of. You add check processing, payments and transaction processing, and ACH, and credit card and debit card. And the next thing you know, you got a pretty robust banking data processing technology world. Fast forward to the evolution of really the PC world. We have one of the world's preeminent engineering and research universities, Georgia Institute of Technology, Georgia Tech, spawned a lot of really cool technology early on in those days. We ended up with IBM's mid-range division, headquartered here for a long period of time. So a lot of the legacy core processors in the banking space were tightly connected to that IBM world around the System 3X, AS400, Jack Henry CIF 2020, the Horizon product that's part of FIS. So you had this real interesting dynamic happening here. The birth of the Equifaxes, what became Equifax's card processing platform came out of First Atlanta, became First Bank Card, became Equifax, was spun out, becomes Certegy, becomes FIS. So there's this bubbling history that's been there forever, and that innovation, that convergence of technology, of communication, of banking knowledge that was here, that really fostered a very robust, healthy group of entrepreneurs, starting in the 70s and 80s. Stockholder Systems, SSI, which beget Check3. The early origins of a lot of Fiserv's business came out of First Financial Management. When Amex spun off First Data, a large part of it was here. Western Union ended up here with its acquisition from First Financial Management. And so the underpinnings of that, the entrepreneurs, some of our legendary fintech practitioners grew out of this just really, really cool thing happening. And a lot of us just happened to be in school or starting in our banking careers when all this was happening. So we got a chance to really see it up close and personal. And fast forward to 2020, we have, I would say, more professionals, more entrepreneurs who have a deep-rooted understanding of banking technology, transaction processing, credit card processing, really the underpinnings of money movement, which is really the thread that is fintech that flows through so many businesses. So, Delta, Coca-Cola, UPS, all of them benefit by a lot of this fintech knowledge that has been here for 40 plus years.
That was Charles Potts, Chief Innovation Officer at the Independent Community Bankers of America, on Atlanta's rich history as a financial services hub and a catalyst in creating innovative tech companies and thriving small businesses. We've also seen the rise of cities like Austin, Charlotte, and the Research Triangle as important centers for fintech and financial services. Yet, in a post-COVID world, the southern United States is facing unprecedented challenges to support and grow small businesses. Beth Bafford is Vice President of Syndications and Strategy at Calvert Impact Capital and an architect of the new SOAR Fund. That's SOAR for the Southern Opportunity and Resilience Fund. Beth, what is the SOAR Fund and what's the purpose?
Thanks so much for having us. The SOAR Fund is really a collaboration of local community lenders who have come together to support small businesses throughout this economic recovery. The community lenders have really come together to say, we think that this is a region that needs attention. We think this is a region that has been historically disinvested, but we see an enormous amount of opportunity and potential if we have the resources to support the region's entrepreneurs. And that's not just the entrepreneurs that are located in those city centers that you mentioned, the Atlantas and the Charlottes. It's looking at the rural communities that are around the suburban communities, the agricultural innovation that's happening, the industries that are outside of those urban cores. There's an enormous amount of talent, opportunity, and potential there, but there's unequal access to capital support to really help entrepreneurs grow. And so this fund and program was really pulled together to say that we want to see an equitable recovery this time around, unlike coming out of the Great Recession. And how do we pool our talents? How do we pool our resources to ensure that that's the case?
So how are the banks and non-bank lenders participating in the SOAR Fund?
Yeah, so it's really led by non-bank lenders who are based in these communities. So these are a group of local community lenders certified by the U.S. Treasury Department as Community Development Financial Institutions, or CDFIs, who really have the ability to provide high-touch support and services to entrepreneurs, to support business owners with both support, assistance, strategy development, and help, as well as affordable and flexible financial products. And I think that's really the magic that happens at the CDFI level, at the non-bank level in these communities, because they are able to be more flexible, more supportive, more hands-on in really helping entrepreneurs grow. But the banks play a really important role too. So the banks are bringing the capital in the structure that is being blended and with philanthropic capital to create a scaled loan purchase facility in fancy financial terms that essentially allows those community lenders to do a lot more lending than they could otherwise do. And so the banks and other corporations are coming together to provide the capital that those community lenders can then lend in their communities.
I was just going to say it's really a multiplying effect then of them being able to work together and using the CDFI structure.
Exactly. So the banks and the corporations are the enablers. The CDFIs are the distribution.
So how does this fit in with the Paycheck Protection Program and some of the other governmental programs that have been launched over the past year or so?
So the Paycheck Protection Program, or PPP, and other government programs were really built to be immediate relief for small businesses. They were built to replace revenue that they otherwise couldn't earn because their customers stopped coming or because their doors were shut. That was extremely important and critical funding. We all know those programs had their limitations. So the SOAR Fund was really built as we shift from immediate relief to long-term recovery. And it's really about access to credit for businesses who might have a path to reopening, but really need to invest in certain things to do so. They need a new HVAC system so that their filtering is okay. They need PPE for their employees. They need plexiglass for their retail layout. All of those things that are requirements to open cost money. And a lot of business owners, particularly the smallest business owners, have depleted their reserves 6-9 months ago and don't have the capital to invest in those expenses to reopen safely. And so this is really making sure that those business owners have access to credit, can smooth out their revenues in the early months of the recovery so that they can get back on their feet and get back to operating successfully.
Well, you did a nice job there, kind of explaining the difference between the short-term emergency use of PPP and longer term. What is longer term? What kind of time frame do you expect these kind of funds are going to be used for?
So, if we're learning lessons from the last recovery, from the recovery out of the Great Recession, we did not see commercial lending rebound for 10 years after the depth of the Great Recession. So we need to take the long game here if we expect to see an equitable economic recovery. So we're focused right now. We're focused on getting loans in the hands of small business owners today and tomorrow and for the next 6 to 9 months. But we're also really building this to be a program that lasts throughout this economic recovery. So to really try to change the paradigm for many small business owners who lacked access to credit pre-COVID and need it now and will need it going forward. We feel like if we could really boost the capacity of CDFIs and boost the role that community finance plays in the broader financial system, we can see much greater kind of distribution of opportunity, of entrepreneurship, of business ownership, which we think, importantly, helps address some of these deeply ingrained issues, particularly in the South, of lack of economic mobility and the racial wealth gap, which are, we're all trying to solve.
Well, there's a couple of things I want to follow up there. One is I want to come back and talk about why the South in particular. There's some kind of unique situations there that I think you can speak to. But also what you're talking about and focusing on longer term, I mean, it kind of just exposes some of the structural flaws that we have in the traditional banking system, right? I mean, the CDFI program has only been around, 25, 30 years, something like that. And it probably is time for another evolution around that. Maybe you can speak even just outside of the SOAR Fund, but just from your perspective, what are those gaps and what are the kinds of things that we need to provide? I mean, the heartbeat of America is, well, maybe Chevrolet, but it's really the small business. And so any kind of program that's helping small business, I think, is really good for the economy as a whole. What do those gaps look like? And maybe you can speak to how SOAR is trying to fill that, but there's probably even some needs beyond this, right?
Absolutely. And I think that's really what I see as one of the silver linings of the COVID crisis is that it just created the broad awareness that our banking system has moved so far away from local small businesses, from local communities over the last 15 years, if not more. And so much of the economy is disconnected from a bank relationship. I mean, I think that's really what PPP showed us and kind of brought to light. I always give the example. I've a lot of small business owners in my family. My cousin owns a running store in Baltimore, and he had a banking relationship with a local bank for many years that helped him provide access to credit to get a loan. And that bank was purchased by another bank. We've all seen the massive M&A activity in the banking industry. And so the relationship manager went from someone in Baltimore to someone in upstate New York. And with that, he lost the ability to pick up the phone and call his banker and explain if there was, more than typical rain in a month and he was delayed on his payment, or if he had to restructure his payment structure. All the things that were so typical in banking and lending that was relationship-based for so many years has just shifted dramatically as the banking system is consolidated, and we've really lost a good number of our local community lenders. And so, this is a moment where I feel like where we have the opportunity to kind of look at the banking system as a whole, understand where the gaps are, and try to figure out how do we fill those with technology, with local lenders, with different models, so that we are providing access to quality and affordable financial products to entrepreneurs and individuals in a way that is much more equitable.
Well, and even outside of the consolidation and the proverbial big bank out of town now has made it harder, there are still a lot of community-based organizations that have all the best intentions in the world. They really care about their communities and really want to serve them. But some of these structural issues around the capital and the regulation and all of that just really makes it tough for them to have a lot of flexibility. And so programs like CDFIs and what you're doing now with the SOAR Fund really helps to fill in a lot of those gaps. And I just feel like this still doesn't do it, right? We still have a lot of gaps and a lot of room to fill in so that the banks can live up to their intentions and be able to serve those small customers even better.
Yeah, absolutely. And I think that's where we've really been trying to push on how do you look at some of these models and how do you create a kind of step change in scale for CDFIs? CDFIs are incredible organizations. I think the entire industry of loan funds is 1/9 of the size of JP Morgan. Right? I mean, it is on the scale of the financial system. They are small, but they're extremely important. The role that they play, that as you mentioned, in being able to be flexible, to be supportive, to provide services, is extremely important, particularly for the most kind of distressed and under-resourced communities. And so how do we help them with the help of technology, with the help of public sector investment, to really play a bigger role in our banking system and serve a 10x, 20x, 100x the number of clients than they serve today.
Well, and go back and talk a little bit more about why the Southern U.S. What is it in particular about the South that drives not only the need, but how this will benefit beyond the South?
Yeah, absolutely. So the need is enormous. I mean, I think what's really interesting is that we've been digging into kind of the access to resources across asset types in the South, and they are chronically underfunded across each type. So if you look at bank assets in the region, significantly less than a lot of their peers across the other regions of the U.S. Venture capital is unbelievably limited. There's some strength in areas like Atlanta and like Charlotte. Mississippi got less than $8 million of total venture capital investment in all of 2019. Right? I mean, it is astonishing the lack of capital that's going into the region. Then you look at philanthropy. There's significantly less philanthropic activity in the South, particularly when you look at philanthropic support going to kind of structural economic challenges, where it's, I think, 33 cents on the dollar in other regions. And so it's a region that it just has been historically underinvested. And so if we can bring new resources, if we can highlight the opportunity and potential in this region and show that with intentional focus and support really led by local organizations, you can start to move the needle on the challenges like economic mobility and the percentage of the population that lives in a distressed community. You can do that anywhere. And I think that's really what we're excited about bringing this model to a region of the U.S. where there is no lack of talent, but a huge lack of resources, and showing that we can really kind of turn on this incredible network of local community lenders to see a difference across the whole system, across the whole ecosystem.
Well, in many ways, some of the things that you talk about are true across the rest of the nation and really across the world, right? We've got pockets of hyper development and expansion of wealth right alongside areas of very dramatic need. And in the U.S., the South continues to be one of the fastest growing regions in the country in terms of population growth, but it's also home to 8 of the 10 states with the lowest household income and 5 of the 10 states with the greatest level of economic inequality. So that those trends that we're seeing everywhere are maybe even a little bit more pronounced in the South.
Yeah, and I think the real challenge of the region is how do you leverage that top line economic growth, that population growth, and the kind of purchasing power that's coming with it to benefit the people who have been there? How do you support the entrepreneurs in the communities that grew up there to kind of access some of that growth and start to make a difference in economic mobility? And I think that is, we feel like entrepreneurship and small business ownership is one of the pathways to doing that. So that a restaurant outside of Durham, owned by a family that's been there for 100 years, can really benefit from all the people moving to Durham, and from that kind of top line economic growth. And I think because if all of that is just benefiting the transplants, I think we will have failed. And I think that's really the challenge that we all have, and why we feel like it's so important to be working with and through local organizations who really understand the context and the character of their communities.
Is the SOAR Fund positioned to help formation of new businesses as well, or is it mainly focused on helping existing businesses?
It is. That was actually a change we made as we were designing this over the last 6 months or so. It was initially just for existing businesses who had experienced a direct impact from COVID. But then we started to see these trends of new business starts, of entrepreneurs who had shut down businesses that were just not viable, who started new businesses in the same industry that were more COVID friendly. And we didn't want to leave those folks out. And so there is a portion, each of the local community lenders can lend up to 15% of their allocation for lending to newer businesses. So that we are also supporting those new businesses. And these are not businesses that would meet kind of a venture capital profile, right? These are businesses that need access to a working capital loan to kind of get up and running, to build inventory, to start, to invest in marketing and to start up. I think there will be more venture capital programs coming to the region as well, but this is really for that small business that needs a loan and is disqualified from pretty much every other source because they're new.
Yeah, I think that's another area where we just talk about the structural impediments, right? If wanting to start a new business and lack of capital is always a major hurdle, and if you're not a part of that network coming from a rich family or went to the right school and knew all the right VCs, it can be a real challenge. So I'm glad to hear that that's a part of this. Well, where can people learn more about the SOAR Fund and apply for a loan from the program?
Yeah, absolutely. So you can go to thesoarfund.org, so the SOAR Fund.org. That website has all of the eligibility requirements for the program, the loan terms that are being offered, and then it's a very simple pre-application. So you fill out kind of 15 questions about your business, your operations, and based on your location and the answers to those questions, you're matched with your local community lender. And then once matched with your local community lender, they'll take it from there. They'll reach out to you, they'll gather documentation, go through the underwriting, and really provide the support that the business owner needs to get access to credit. So we're live and accepting applications now, and really excited to be offering this program across the region where we see so much potential.
Well, we're excited to see how it goes. So keep us posted, and maybe we'll have you back to update us on how we've been able to advance some of the objectives that the SOAR Fund was designed to do. So Beth, thanks for joining us today.
Thank you so much. Appreciate all you do, and love listening to the podcast. So thank you.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.